Hi, my name is Brenton Harrison, and we're here today to talk about whether you need to buy your own life insurance when you have plans available to you at your job. Let's get started. If you work for a corporation or a small business that has more than a few employees, it's highly likely that at some point in the year, your HR office or your HR representative or your employee benefits office tells you that it's open enrollment time. And open enrollment time is a time where employees get the option of going through the different benefits that they're offered, be it a 401k or health insurance or dental or vision, to decide what they do want to take advantage of and what they don't want to take advantage of. And during this process, it's highly likely that you have some form of life insurance or group life insurance that's offered by your employer. Group life insurance, depending on where you work, may be pretty affordable. So you, if you're trying to be economical and save costs, might see it as an opportunity to get all of the insurance you need in case you die for your family without having to go purchase additional coverage of your own outside your employer. But is that the right move to make? Oftentimes for our clients, we encourage them to see their employee benefits in terms of life insurance as a bonus and not something they depend on when it comes to life insurance. But I want to walk you through a few questions that we ask those clients so they can understand how those benefits work and also why in many cases, not all, but in many cases, it benefits you to purchase the coverage that you truly need outside of your employer. When looking through the employee benefits when it comes to life insurance, the first question you want to ask yourself is it actual life insurance or is it life and accidental death and dismemberment? Here's the difference. Life insurance is insurance that pays a benefit if you are to die. As long as you don't die while committing a crime or any other things that are excluded in that policy, it will pay you for natural causes, accidents, what have you. Life insurance pays a benefit if you die while being covered. Unlike life insurance, accidental death and dismemberment policies are policies that only pay when you die under certain circumstances. As a matter of fact, it's in the name, accidental death and dismemberment. For example, in terms of dismemberment, it may pay you if as a result of an accident you lose the ability to function with a hand or an eye or both hands, both feet, one eye and one hand. It has a number of things that they'll pay for where they give you lump sums when you experience a disability or a loss in those areas. And when it comes to death, they will only pay if you die under a certain set of circumstances. And we often see that clients think that they have pure life insurance. They'll say, I have $100,000 or $250,000. And then we find out that they have an accidental death and dismemberment policy, which means that if you die of natural causes, that policy will not pay. So the first question to ask yourself is, do I have an accidental death or dismemberment policy that I'm factoring into the equation when I calculate how much insurance I have when I die, or do I have a pure life insurance policy? The next question to ask is if your policy is portable. This is a huge one in today's society because for most of us, we do not spend long periods of time at one employer. And what that means is from each job to the next, we're subject to different employee benefits that are offered. And if you think about it, if you sign up for a policy through your employer, that's what's called group coverage. It is coverage that is offered to the group that works for that particular organization. So if you do not work for that organization anymore, you want to make sure that if you have coverage you're depending on when it comes to life insurance, that the policy is portable, meaning that you can take it from that group and leave with that coverage if you leave that job. Portable insurance often means that you have to pay more for it when you leave, because oftentimes your employer is helping to pay for some of the cost of your coverage while you're working for them. So if you have a portable policy, you may be able to take it, but since your employer is no longer helping with the cost, it may cost you more to do so. But having a policy that's portable is obviously more preferable to having one that isn't. Because if you have a policy that isn't portable, then the coverage that you're depending on won't be able to go with you from job to job. Now, why is that important? Well, the older you get as you switch those jobs, if you need to get your own coverage at later and later ages, it's going to cost you more to do so. So if you're depending on coverage that you can't take with you, and then in your 40s or your 50s, or heaven forbid your 60s, you switch jobs or leave your job and don't have access to another group plan, you could now be significantly older trying to apply for coverage at a rate that is much, much higher than what you would have paid if you had simply gotten your own policy years before. When you're working through those employee benefits and trying to decide whether that policy is portable or not, it may not be something that's listed in the summary that they give to you as an employee. You might instead have to go directly to your HR representative or ask for a copy of the policy itself so that you can read the terms and definitions to know whether that policy can be transferred into your individual ownership if you were to leave that company. If you're not sure, then I would err on the side of caution in getting your own coverage, but you want to make sure you go the extra mile of asking somebody if that's coverage that can be taken with you when you leave that job. Next, you want to know if your policy has what's called a reducing death benefit. You see this many times when you're working for like a government organization or a university where you have this coverage where it is portable. You can actually take it with you when you die. But if you look in the fine print of those policies, you'll find that some of them have what's called a reducing death benefit. And what that means is when you get to a certain age, the benefit that you have if you die reduces by a set percentage each year. Oftentimes it will reduce by, say, 10% per year for 10 years or 9 years, which means that if you at, say, age 70 have a policy that you took from a previous employer and you greatly needed that coverage for your family if you were to pass, but it had a reducing death benefit of 10% every year for 10 years, that 10 years after you have left that job, you may be left with only 10% of what you had at the date of your retirement. So if you really needed $200,000 or $250,000 for your family, well, 9 or 10 years later, if you were to pass, that may only get $20,000 or $25,000, which is obviously not what you were expecting. All of these things are reasons why you can't simply just sign up for these policies at your job and assume that you can't get coverage or shouldn't get coverage outside of the workplace. This is one of the reasons, and these are some of the reasons why we encourage people to not be stuck in the lurch, understanding or trying to understand the benefits at their job, but instead locking in their coverage outside of their employer, because reducing death benefits are something that are also in the fine print. It's not something you're going to see in the summary of that group coverage during open enrollment. So if you're depending on that work coverage because maybe you are too old or not in good enough health to get your own coverage, again, you want to go the step beyond and ask for further details about not just the portability, but also whether or not that policy's death benefit will be reduced years after your retirement. Lastly, you want to ask yourself if you're healthy enough to get your own coverage outside of the workplace. I said earlier in this video that life insurance through your employer is what's called group insurance. And what that means is that there is essentially, for lack of a better terms, a master deed or a master insurance policy that covers all of the people who work within that certain company. So instead of you having your own individual coverage, you are instead part of a group that is applying together. And when it comes to setting the rates that you pay for group insurance, even though your employer might be paying for a portion of it, there's still a pure insurance cost that you would have to pay in full if you left that job. And when they set those rates, they go off of the average age and the average health of all of the employees of that organization. So if you're like me, I work in financial services, and this is an industry that typically skews a lot older than what I am as of the time of this video. So whenever I go and I look for a group policy that's maybe offered through an association of financial advisors or a group that I'm affiliated with, I find that the rates that I'm paying are much higher than what I would pay by simply going in good health and applying for my own coverage outside of work. If you're looking at your job and you see the people around you and you're typically younger or in better shape than the people at that job, you might find that you can get better rates than what you have with your employer outside anyways. And again, I often encourage people to go that route, to take that option of having their own coverage, because of all the reasons that I mentioned before, group insurance just isn't something that you can always depend on in your time of need. Whenever you're tying your coverage that your family desperately needs in terms of your death benefit to a job that you may not have at the time of death, you're putting yourself in a situation where there's just uncertainty there. But when you have your own coverage, if you're blessed enough to have good health and age is on your side, then you want to take the opportunity to lock in what you can now so that if that time comes when you pass, your family is not left wondering whether their policy is in existence or whether it is expired because of your current situation. I hope this video has been helpful to you and has given you some tips in helping understand when and when it is not important to have your own coverage outside of your job. Again, my name is Brenton Harrison. We'll keep having these videos coming to you soon, and I'll see you next time.